Hey, welcome everyone to Stock Wisdom Tips. Today in this video, we'll be talking about the US bank earnings that are coming up. Very, very important time in the market. Of course, it happens 4 times a year. And the banks are very important for several reasons that we'll highlight. And this particular quarter, they're actually quite unusual. They're actually reporting all on the same morning, or most of them on the same morning. The big ones, that is. Goldman Sachs is actually reporting on Thursday, October 13th. But the rest of the banks that we'll be talking about today are reporting all on the morning of the 14th. So most definitely a market moving potential set of events. So why are bank earnings important? Why are banks important? As mentioned, they kick off the earnings season every quarter. So, mid-January, beginning April, July, and October are the 4 times the banks, as public companies, report their earnings, as do every public company. Not those months, but 4 times a year. Now, there are some rock stars, if you will, that are CEOs of some of these banks. And anytime they speak or provide commentary on the economy, the consumer, which, consumer spending makes up a large proportion of the economy. I think it's something like 2/3 of the economy is made up of consumer spending. And then markets as well, right? Where do they think the economy is going? Where do they think the market is going? Jamie Dimon has made some really controversial comments about cryptocurrencies, saying they're a scam. So very important. They've got an excellent view on the entire economy. These companies, own have credit card. They obviously issue mortgages, deposits, payments, etc. So a real good snapshot on the economy, almost probably as good as the Fed, one may argue. Now, in tough markets or tough economic times, these reports are even more important because, again, anytime the consumer is hurting, they're spending less, the banks will see that. And also, the banks have ways to leverage any potential losses. So, increasing or decreasing their reserves. Stress tests as well are an important component of, since the 2008-2009 downturn, these stress tests have been very important. So again, a very important barometer as it relates to the economy and the markets. Now, banks have, as everyone knows, have been in business for decades, if not centuries. Some of these names, they are solid as a rock investments. And honestly, very good, excellent gains come when markets do turn around. When markets are suffering, banks take a hit. But banks are as blue chip as they come from an earnings perspective, if you will, from a business perspective. Now, one thing that's important, we'll talk about in a couple of minutes, some key metrics when it's when you're comparing, banks, trying to understand which banks are favorable, which are good buy opportunities. There's a metric called price to tangible book value. This is a really important metric. Essentially, it expresses the share price of the stock as a proportion of the company's tangible book value. And they use tangible book because, first of all, you're subtracting intangible assets, but the book value fluctuates much less than earnings, for instance. So when something is relatively low compared to their tangible book value, they're cheap, right? If they're selling below the company's tangible book value. So let's take a look at, this isn't an exhaustive list of all the banks, but it is the major banks. There's a couple of investment banks on this page as well. And this is a chart that I use to sort of understand, comparatively speaking, where we are, which of these banks are good values. So, you know, price is one thing, but what you want to look at, of course, as we mentioned, the price of tangible book, you want to look at the PE. We talked in another video some key dates that you need to look at. So 52-week low is great, but that's certainly not exhaustive of the things that you need to look at. The COVID low now you need to look at. The December 18 S&P 500 low is also a good, good barometer to compare. And then dividend yields as well, and the market cap. So relatively speaking, if you look at the top 4 banks or the top 5 banks in the US, so JP Morgan, Bank of America, Wells Fargo, Citigroup, and US Bancorp, you see, you see their market caps, which correlates with the assets under management. That's how a bank is rated as a large bank, if you will. So, you see Citigroup at 80 billion. JP Morgan is about 3.5 times from a market cap perspective. In terms of value, I'm looking at Wells Fargo and Citigroup as potentially interesting names to look at. Wells Fargo is a turnaround story. They've been hit by a lot of regulatory slaps on the wrist in the last few years. They've got a new CEO. He's trying to turn around things, and I see Wells as a good potential for a turnaround. And then Citigroup, from a price to tangible book perspective, also from a dividend yield perspective, they're cheap. Now, again, if the world goes into a recession, they've got exposure, not just in America, but in international, geographies as well. But their new CEO, she's very intelligent, and in my opinion, making some good moves, some smart moves to make the bank more competitive and avoid some of the negative things they went through in 2008, 2009. Now, I've included Goldman Sachs and Morgan Stanley on this list. They're more seen as investment banks, but again, in tough markets, what they tell us in terms of their trading performance as well as their retail performance, how folks like you and I are trading stocks, if we're actively or not, is also good commentary and good barometer to what's going on out there from a stock market perspective. So again, October 14th, the morning of, before markets open, key earnings date this year. Watch those numbers carefully. Listen to the earnings if you have time, but definitely get a highlight of some of the key points that these CEOs and that these earnings are communicating. Thank you so much for listening, and here's to financial success.